cutting rates.
Let's jump into it right now. The gentleman who knows the Cubs are behind the mark here in April and into May, and maybe we'll look forward not to Cubs baseball, but maybe what our Federal Reserve System will do. James Bianco is founder and president of Bianco Research. Jim, what are you going to write about this weekend?
About the economy, I think, in that there is a fundamental shift going on. It's probably the biggest story that no one talks about, is this whole work from home phenomenon is something real, and it's something that's going to last. A recent study said that only 8% of the offices in Manhattan are back to full time. Everybody else is either work from home or hybrid. I think it was behind the target numbers too. They've got an inventory build on a lot of stuff people don't want, because when you've shifted your patterns of work and home, you shift your consumption basket. And I don't think we're ready to acknowledge that that's happening. And that's keeping the economy offsides, and that's keeping a friction in the economy and inflation higher than it would otherwise be.
So, Jim, what does that tell you about this week? Does that highlight the struggle the C-suite is having navigating this economy, one? Or two, does it signal a weakening of the economy? Because we traded on the latter, really, not so much on the former.
Yeah, we are trading on a weakening of the economy. And you've also seen it, say, in things like the Bank of America survey, where all of a sudden tightening monetary policy and global recession have surpassed inflation as the #1 tail risk for the first time in many months. And everybody is now worried about a global slowdown. I am too. But then they come to the conclusion that the Federal Reserve and other central banks are going to have to pause or pull back on their tightening after some round of initial tightening, say in the June meeting and maybe in the July meeting. And I don't see that. I see the central banks as being committed to trying to rein in inflation. And if you want to put it in market parlance, the Fed put is about unemployment and the inflation statistics. It's not about what level of the S&P do they change at. It's at what level does inflation have to come down to, or maybe unemployment have to rise. And I don't think a lot of people are, at least on Wall Street, ready to accept that as an answer. They think the Fed's going to stop because they're having a lot of pain. But a lot of people that have to live on a fixed income, that's who the Fed is focused on.
Jim, translate your view into a market call where a lot of people are saying buy the dip in bonds, and they're seeing a peak in yields exactly because of what you're saying, because they do believe that central banks will pause, that we will get inflation under control still, and that we can move along back to some sort of normal that we remember. What's your view on that?
You know, it's possible that we saw the high last week at 320 on the 10-year note, but I would probably bet not. What I think we're seeing now is a flight to quality. The stock market has been so volatile as of late that it's really trading, the bond and the stock market are trading as one. If you see a serious rebound in the stock market, you know, you're right, we're about to have the 7th down week in a row. If we actually had 2 up weeks in a row and you didn't see bonds make a run back at 320, then you'd have a chance of saying that we've seen the high. But I have a feeling that once the stock market finds its sea legs and then attempts a retracement rally, that yields are just going to go right back up again. So I understand the argument for 320, 10-year being the high of the year. I'm just not sold on it yet.
So where do you think we really see that capitulation? Can you elaborate a little bit more about the balance of buyers of some of these bonds and what people might not be understanding fully?
Well, there's been, at least in the statistics, not a whole lot of capitulation. If you look at the future statistics or the surveys of managers, there's nothing there that suggests that we've ever gotten to an extreme short or underweight position to begin with. So it's been a year of real pain for fixed income managers. I suspect that they're still holding out hope that the slowness in the economy will get the Fed to stop, and that's why they're trying to make the case for a turnaround and a rally in bonds. But I still think that the capitulation is to come. One other thing, whenever you've seen throughout the last 50 years, whenever you've seen yields go up this much or total returns in the bond market, that's including price, fall this much, I always like to say that the bond market doesn't peak in yields until something changes. So it's usually bond yields go up a lot and something big happened, like a recession or like a financial crisis or a serious slowdown in the economy at a minimum, and then that was the peak in yields. If last Tuesday was the high in yields, you'd say we had one of the biggest rises in yields or biggest declines in total return, and then some random Tuesday they peaked and that was the end of it. I'm not so sure that that's going to be the case this time.
Hey, Jim, awesome to hear from you, buddy. Thank you. Jim Bianco there of Bianco Research. Some of this has been pretty